When you look at stocks, looking at the nominal value is not sufficient to determine if the prices are too high. First, you have to adjust for inflation, which nobody ever does. You can look at volume, PE ratios, and hundreds of other indicators, but there is one that stands out above the rest. One indicator that causes a massive cascading effect. Oh, and it's at a record level right now. You came here for the truth, so let me unveil that for you. Today we're going to look at this one very important indicator that is hidden in the mainstream media. So we're going to look at it today. Investors borrowing record sums to bet on stocks exacerbated this month's sell-off after they were hit with calls to reduce those obligations and forced to sell shares to raise cash. What are we talking about here? Margin, that's right. If that debt, known as margin loans, continues to rise at the current pace, analysts warn that big sell-offs and sudden bouts of volatility in the stock market could become more commonplace, and surely they will. Retail and institutional investors have borrowed a record $643 billion against their portfolios as they try to pocket bigger gains by ramping up their exposure to stocks. So if people don't understand what margin is, imagine, just take for example, you have $1 to invest, but you want to be able to invest $2. Well, you don't need to have that extra dollar. All you need to do is bet on margin. And so it's as if you're betting $2, but you only actually put $1 in. But guess what happens when the stock declines? Just a small percentage of a decline starts to mean a lot more. And then you get your margin call. And that hurts very badly, very quickly. So everything's fine on the way up, but it really sucks on the way down. But they were left vulnerable when the Dow rapidly tumbled more than 1,000 points during two separate sessions earlier this month. Money managers say that the penalties these investors face from their brokers for trading on margin helped deepen the rout. All right. So they talk about examples of what happened here, but I want to show you the charts. Two very similar charts here showing you how it's happened. Since 2011, it has been increasing significantly, $643 billion. Look at this. Margin debt has reached record levels in recent months, stirring concern among regulators and analysts that investors are overexposed to a downturn. It has been steadily rising over this period of time. Many people would say that this is not an issue. But how could it not be an issue when we know that at some point, maybe it's going to be 10 years from now? Okay? But where will we be at? How much margin can we get and not have that be an issue when the time comes? If stocks decline by, historically, 50%, very normal. The average person would say, we have no problem with that. I can take a 50% hit. Not an issue. I've increased my portfolio by, let's say, 100%, so I'd still be up by 50%. I'm doing well if a crash happens and it's only 50%. Well, is any of that on margin? We're talking about nearly $700 billion worth. And that's what they're telling us, of course. I'm sure that's much worse. And this is in one market. Now think about this for a moment. What would happen? That cascading effect, the snowball, the domino effect. What would happen should a lot of these people start to get their margin calls? Stocks tumble further. More margin calls. Stocks tumble further. More margin calls. That's the big issue that people don't want to talk about. Because as long as stocks are moving up, everything's fine. Even if they move sideways, everything's fine. It just can't move down. But don't worry about it, because the Federal Reserve will print money and push the stocks back up. That is the general consensus. And I'm not even suggesting that it won't happen. But have there ever been crashes before? Well, come to think of it, yes, there was. There was a crash. 2008. There was a crash. 2000. There was a crash previously, before that, and before that. And guess what? The Federal Reserve was there. And somehow, they didn't just magically fix the problem. Well, maybe they were on vacation. Of course not. So why wouldn't it happen again? Stock sale. Investors have been pulling money out of U.S. stock funds amid the recent market turmoil. This is some interesting information that I saw here. You can see it for yourself. It's interesting. I think that maybe they're shifting their portfolios. You're going to see maybe they're putting into cash. I don't necessarily know what they're doing here, but all I know is that margin is continuing to increase. So maybe real money is pulling out, but ultimately we could see stocks going higher, and they really have to be pushed further up. Maybe a little bit of central bank intervention would help. Other banks, the Bank of Norway, maybe the Swiss National Bank is going to come in, swoop in, and buy some more since prices have come down a little bit. Even Warren Buffett's a little concerned at this time. Now look at this. Goldman Sachs, everyone's favorite. If the 10-year U.S. Treasury yield hits 4.5% by year end, the economy would probably muddle through. Stocks, not so much. That's according to Goldman Sachs themselves suggesting this. So we'll see what's going to happen with that. I don't really know personally. I don't know if that's an accurate statement, but I'll tell you, it's not going to take much. It's really not going to take much. I mean, based on history, what I've seen before, that rates increase just a little bit and it makes such a huge difference. Okay, now this might be a little confusing to see, but we are actually looking, and this is on the SEC's website, you're looking at Goldman Sachs, okay? They only had 4 days in which they generated only, let's say only, $100 million or more in profit. Daily net revenues. Now, you would say, okay, $100 million, that's a big number. But for Goldman Sachs, that's actually terrible. And in fact, it hadn't been this bad since 2004. So we are talking about something really messed up going on in this system right now, where a company like Goldman Sachs isn't able to get the returns they were used to. Interesting, anyway. I thought it would be something to share. Now, this is from Bank of America Merrill Lynch. I believe it was either 13 or 14 of their indicators, of 19 indicators, had flashed. They triggered, saying that there will be a crash. I'm not saying that personally. I'm showing you Bank of America Merrill Lynch. 13 or 14 of these indicators just got triggered. Whether it's the Fed raising rates, doesn't take much. In fact, they said right here, bear markets have always been preceded by the Fed hiking rates by at least 75 basis points. That's already happened. So you'll go through this here, ones related to the S&P 500 and so on. I mean, there's a lot here. I just wanted to show you the fact that they're suggesting this. It's interesting. Let's add it to the other countless indicators that I've shown you over the years here. Now, does that mean, all of this I'm showing you, does that mean the stock market is going to crash? No. All we need is QE4. Market starts tumbling down, margin calls, everything's tumbling, no worries. All we need is the QE4, central bank comes in, prints up the money, devalues the currency, stocks will rise. That's it. That's the solution. But of course, we're devaluing the currency. And in doing so, you start to upset the rest of the world. And guess what? They engage in the same policy. They also print. And they print more and they print more. And it's a battle back and forth. And this is going to be something that we'll see. And they'll fight in here all the way and spiral downward, destroying all the currencies, and we will be using worthless confetti. The real winners will be those holding real assets. If you look in a country today that they have a hyperinflation, anybody who owned anything is doing better than those who had nothing. So if they happen to, for example, have a house, that house would be worth something. If they were unfortunately living in some sort of a shared place, maybe it's a rental unit or something, they didn't have that asset which could appreciate in value. So although it's, of course, technically not an asset, your own property, but when you look at it in a different way, at least nominally, the price had gone up. And so that individual who may not have anything else, at least they have something that had appreciated nominally. Maybe they had a lot of these areas around the world, it's not typical in the West, but a lot of areas have jewelry, high carat jewelry that they pass down. Maybe it's gold coins. A lot of cultures do this. They give gold coins to each other during different celebrations. And so they're able to pass that wealth on. And guess what? Times tough, they can sell some of it. They probably wouldn't want to, but hey, if times are tough, they can do that. They can sell it. And so they're able to recoup some of their losses. They're able to, buy food, whatever they need. So it's just interesting to say the least. I won't go on anymore. You've heard me rant about that before. Government debt to GDP forecast until 2050. I mean, take your pick. US, Germany, Japan, it doesn't matter. They're all going into parabolic levels. Parabolic levels that we are seeing here. And these are countries that are all considered to be strong. Don't worry about it. This country's strong. This economy is good, that economy is good, doesn't matter. Debt to GDP is one that we can see has gone from bad to worse, and it's going to get a lot worse. And I believe that at some point the central banks are going to come in and they are simply going to print to infinity. Look at what happened previously. We're just going to see another example of that. So I think there's going to be a real deflation that occurs. By the way, I concur with Mike Maloney's assessment of this. We'll see a real deflation, and as a result, the central banks come in, they print up the currency, and just absolutely devalue it to the bottom until there's nothing left. It's confetti, nothing but worthless garbage. That's what to do. That's why you need to own real assets. That's why you need to own businesses, things that will do well in tough times. That's what you can do. If you found this video, and by the way, I should interject, and of course, having real skills. Real skills are very important. All right, that's it. If you found the video informative, please give me a thumbs up. When you give me a thumbs up, it helps to support the channel. We're closing in on 90,000 subscribers at the time of this recording. So I appreciate all of your subscriptions. Make sure you hit that subscribe button. I do videos every day, and I would appreciate that if you hit that button there. And last but not least, if you found this video informative, I know that you will find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. You can flip through these books for yourself at Amazon. There are links in the description below. Take care.